everyone, and welcome to today's webinar hosted by us at 360 Financial Strategists. I'm Stephanie Hortis, and I'm thrilled to be your moderator for the third instalment of our 360 webinar series. So, as we discuss and run through what's been happening in the financial markets, we'll be covering off on topics such as inflation, interest rates, and the impact it's having on shares and property markets. So in putting all this together, we'll discuss how you can position yourself and financial decisions that you make moving forward. So now I'll introduce our esteemed speakers. First off, we have Billy, an accomplished leader of our 360 financial advice team. With over a decade of experience in the financial services industry, he brings a wealth of knowledge and strategic insight to the table. Welcome, Billy. Joining Billy, we also have our senior financial advisors and partners in the firm, Patrick and Andrew. These guys have been developing effective financial strategies to clients, leveraging their extensive experience and understanding of the ever-evolving financial landscape. Now, for everyone that's joined us today, please remember that this webinar is designed to be interactive, and we encourage you all to participate by asking questions in the chat that you'll find in the top corner. And please ask any questions you have throughout the session. Our speakers will be more than happy to address your queries as they go along with their presentation, or we'll touch back on them at the end of the presentation. So without further ado, let's dive into the discussion and extend a warm welcome to our first speaker, Patrick.
Thanks for the introduction there, Steph. In terms of today, guys, I'll talk through a few things. So a bit of an overview on what inflation is, just first of all, just for a bit of background. Some of the recent trends and in Australia and across in some of our trading partners as well, contributing factors to the level of inflation in Australia there, the effects of inflation on the investments that we face, and then the do's and don'ts to mitigate, to fight inflation as well. So delving straight into it, first of all, what is inflation? So inflation in Australia and around the world is a change in the level of prices of goods and services that us households we buy. It's a measure, it's measured as a percentage change of those prices. And in Australia, we look at that as I guess one of the more well-known indicators of inflation is the CPI, or the Consumer Price Index. It's measured as a percentage change in the price of those of a literal basket of goods and services that households buy. That's run by the Australian Bureau of Statistics. There, it's a quarterly statistic that they run to measure that, and the most recent one was I think the June quarter. So there's another one soon to be finalised. The RBA is the Reserve Bank of Australia is tasked with setting the monetary policy, and we have what we call an inflationary target in Australia. So we keep the bands between 2% and 3%. Now, anyone that knows and hasn't been under a rock for the last 12 months has known that inflation in Australia has peaked. So it peaked towards the end of last year, December last year. It's slowly coming down, and obviously we'll talk through some of the measures that they've been doing of late as well. But I guess what it really represents, and to kind of summarize it all, really, $1 today is not worth the same as $1 tomorrow. So that could be up or down. It doesn't necessarily mean that it's always positive inflation. It could be also deflation, but yeah, oftentimes it's a change in the value of the dollar itself. The trend in Australia, and this is kind of looking back since back in the mid 50s when we started actually tracking the data here. You can see, obviously, for a long time, inflation was quite volatile. We've seen inflation, peak at around about the mid-teens, back in the mid 70s, I should say. So inflationary target kind of came into effect in the early 90s. That 2 and 3 band, that's the purple line you see in the graph there. That's the level of inflation where we expect it to be over the long term in Australia. Now, inflation, like I said, last year peaked at close to 8%. The June quarter in 2023, we've seen it come down to just below 6%, and it's trending down, which is why we're starting to see a bit of a slowdown in the interest rates increasing, which is the moderating factor, the correlating factor between, so the inverse correlation between the two inflation and interest rates there. Now, looking at Australia as a whole, like it's been quite, even though we've seen and felt that oftentimes within our family budget and family household, it's actually, by comparison, not as bad as the rest of the world as well. So just to give you a bit of an idea, a bit of a snapshot in terms of what these numbers look like. In some of the trading partners we have, particularly with Australia, United States, United Kingdom, Germany, France, etc. We're actually quite, it's quite an interesting graph to say the least. This is the bit of the economist nerd in me talking here, but you can see here the trend has actually been quite in line with the rest of the Western world. The brown line here, that's Argentina spiking at almost about 100% inflation. They've been trending up for quite some time. And the next slide, just to give you an idea of some of the other experiences, some of the other people experiencing. This is Venezuela. So this is talking about, I think it's 400%, in the thousands, I should say, percentage per day. So, the graph that we were talking before, it's a flat line by comparison. Some of the contributing factors that come into play when you're talking about inflation as well, particularly in Australia, and what we've seen over the last 12 months has been a great number of increases. So any one of these things probably would have had a fairly significant push in terms of inflation itself. Government spending being one of the big factors there. A proportional household debt to income has increased, not necessarily the debt itself, but the serviceability of that debt, and that's particularly because of the interest rates have been increasing as well. The war in Ukraine, obviously, that's still ongoing, and that has once again a flow-on effect. Russia, in particular, is a big exporter of oil, petroleum, and natural gas. And with obviously some of the sanctions that the EU have put in place, that has obviously pushed up the prices there. That naturally pushes up the prices of oil and natural gas, and then that has flow-on effects to the supply chain and importation of goods and services as well. And the last thing has been a bit of a pent-up in demand. Essentially, we came out of COVID. We had a lot of pent-up savings over that time frame as well. So some of those savings are now coming into effect, and a willingness to buy goods for inflated prices has pushed up inflation as a whole. What does this mean, essentially? So effects of inflation, and particularly when you're talking about it in a financial planning landscape. So when we're talking about this and when we're modeling kind of longer term projections for our clients, inflation is a critical variable that we need to take into account. And one of the interesting things, and particularly when you're talking about a long-term inflationary pressure in an economy, that needs to obviously take into account there. This becomes more apparent when you're talking about investments over the long term and into retirement planning, as inflation obviously erodes hard-earned savings. Now, just to give you an example, with inflation kind of being within those bands of 2 and 3% per annum, for you, if you were to retire today on $1 million and retiring on $1 million in 30 years' time, that is only worth less than half. So 412,000 is the rough number in terms of what that number would be valued at in terms of your buying capacity over that time frame. You'd need actually closer to 2.4 million to be equivalent of $1 million today, in today's dollars there. So a couple of things to do and not to do, essentially, when you're talking about inflation. Obviously, cash is important to have. You have to have some sort of liquidity when you're talking about buying things as a whole. When we talk to clients, we'd always say, have cash on hand, have an emergency account, usually about 3 months worth of living expenditure set aside. And if there's any planned expenditures over the next 12 months, have that set aside as well. But any more than that, that's probably too much there. Make sure you've got an updated budget and be obviously mindful of what your spending habits are like as well, pay down any short-term debts that you might have. Obviously, given the interest rates now, and that's obviously particularly interesting in this environment as well. And the last thing is just invest. One thing that we kind of take for granted is obviously the level of compound interest that can happen over the long term, and obviously having inflation as high as it is now, putting money into term deposits or cash, you're actually eroding your assets quite quickly. So shares, property, domestically, so shares both domestically and internationally, property, both either direct or indirect via like a fund manager as an example. And kind of gone are the days of living off interest rates and term deposits. They're probably well behind us effectively. I don't think we're going to see those times anytime soon, particularly. And I guess I always say this to clients is, be willing to invest in the less sexy things. So the predictable kind of predictable assets that will give you long-term returns. They're obviously not as you don't get the highs and the lows, but certainly they're predictable in that sense. What not to do essentially is equally as important. Definitely don't hide your money under the mattress like my grandparents used to do, and I'm sure a few of us on the call today as well. I'm sure you've had family members who've done that in the past. Definitely don't do that. There is such thing as obviously having too much cash on hand. Definitely don't bury your head in the sand and kind of put it into the too hard basket and just you need to tackle it here and now. Just because inflation being where it has been, it just means that it's often often kind of eroding your money quicker than you think it is. And don't invest in, I guess, fads. And when I talk about fads, I'm talking more things like, the get rich quick schemes, the cryptos and things like that as well. And probably just as a bit of a side note to all this, kind of avoid scams. Obviously, we're seeing a heightened level of scams happening over the last couple of years in particular. I saw an interesting statistic today. There was $3.1 billion of lost money due to scams in 2022, and that's an 80% increase from in 2021. So obviously scams are very much a here and now, and they'll probably be sticking around for quite some time. But definitely avoid scams where you can as well. I'll hand over to Stephanie, who will be speaking about interest rates and what's going on the current with the currency in the RBA as well.
Thanks, Patrick. Great insight to what inflation is and I guess the pressures we're facing currently. And I guess a really good segue into interest rates, what I'll be talking about, because what I seem to be finding everywhere is that inflation and interest rates are the two buzzwords that we constantly are hearing these days, whether it's on the radio, the news, discussed amongst peers, just seems to be the two biggest, I guess, trending phrases. So in saying that, I guess most of you would have heard that the RBA are using the interest rates at the moment to combat various economic factors. One of the main ones being the inflation that Pat, you've just spoken about, and that rising cost of living that we're experiencing. So that's straight from the supermarket bills and twofold, threefold increase in those and what they were a year ago, 2 years ago, as well as utility bills and whatnot. So before I get into everything about interest rates and how we're experiencing them at the moment, I'll quickly cover off on the role and the significance of central banks and essentially what the RBA or the Reserve Bank of Australia does for us. So as a brief summary and noted here, a lot of information, but a good visual insight, their duty is to contribute to the stability of our currency, full employment rates, and economic prosperity. Looking after the welfare of Australian people is their main priority. The RBA will always use tools such as manipulating interest rates, which is what we're experiencing and probably most predominantly experiencing at the moment. They will also buy and sell government bonds and change the reserve requirements that commercial banks are required to hold. Now, these three are tools that they use to achieve their macroeconomic goals, such as consumer spending, borrowing capacity, business investments, and inflation. So Philip Lowe, who was our previous governor, has faced a lot of scrutiny over the monetary policies through steering us out of, I guess, the COVID-19 era and our economies leading out of that. Now, in recent days, there has been a changeover of governor from Philip Lowe to Michelle Bullock, who was his previous deputy. With this changeover from Philip to Michelle, I do think it is a good opportunity for the RBA to refresh their leadership and I guess position themselves in a more refreshed perspective that will make a difference to people and maybe see them in a different light as well. So it'll be good to see what will happen coming forward with Michelle taking over and I guess the new policies coming into play soon. Now, moving on into why the central banks manipulate the interest rate. So there is a cyclical pattern involved with economic factors and interest rates. So we can see it in the flowchart here as presented above. So the central banks can try to control the consumer spending or business investment through interest rates. So as Pat discussed earlier, inflation in Australia has increased significantly and is no longer within the ideal range that the governments would like to perceive themselves as an ideal economic range. As you can see, when inflation increases at the bottom here, and due typically to expanding economies or consumers spending a lot of money in the economy, the central banks will hike the interest rates, which is what the current phase we're experiencing at the moment. When consumers feel more pressure directly through their higher mortgage repayments or the flow-on effect of businesses and their increased cost of borrowing. Now, it could also be the tightening of budgets for businesses, higher unemployment rates that also increase this flow-on effect. The economy will begin contracting its growth until it comes into the target ranges. So when we start seeing a slowing down of economic growth, that's when the RBA will come back and manipulate the interest rates again, but in the opposite nature and create cuts. So consumers will then be able to borrow more money to spend on goods and services. Businesses will acquire more debt and invest and grow their operations, and this will stimulate more economic growth. And as you can see, we go around the flowchart until that sort of hits the reasonable balances that the government is trying to aim for. This will also be touched a little bit further down with Billy when he gets into the specifics of the Australian economy currently and what's actually occurring with interest rates. So we'll move on now to what the current cash rate is in Australia. So the official cash rate is determined by the Australian Reserve Bank, and it's currently sitting at about 4.1%. So the difference between the cash rate and what you would see as a mortgage rate, which is what consumers realise on their mortgages, are two different rates. The cash rate is what the interest rate the banks pay to borrow funds from other banks, and essentially is called the money market or the overnight money market. Now, the mortgage rates that consumers experience are what the banks determine their own rates in order to be able to invest in properties or investments and so forth. The official cash rate, as you can see on the graph, from say 12 months ago back in October 2022 or September 2022, has increased from 2.35% to 4.1%. So that's about a 1.75% in just the 12-month period. Go back a little bit further to when it was the lowest ever in history at about 0.01% back in 2022. That's almost a 4% increase in that time. Now, the RBA will meet each month, 11 times a year, taking out January. Now, moving forward, this will now move to about 8 times a year with a 6-month interval. So rather than hearing a new increased rate or rate announcement each month, that will now be prolonged to every 2 months. We'll be hearing the next rate announcement on the 3rd of October, which is when Michelle Bullock will come into, her first announcement, and we'll see whether the rates increase or decrease will be held for the next month. Now, when we look at the mortgage rates and the cash rates and the differences, we're currently translating cash rates into mortgage rates of about 5 to 6% for owner-occupiers, typically about the high 5s to 6s, and your investors are getting about 6 to 6.5%. Now, there are a lot of varying factors when it comes to specific mortgage rates, so I would recommend reaching out to one of our brokers and ensuring that the best market rate for yourself and your circumstances has been achieved. Moving on, now this slide I think is really valuable because it will provide a little bit more perspective than what we're currently experiencing, purely for the fact that it shows the historic graph of the cash rate or the Reserve Bank rate for the last 30 or so years, so from 1990. Now, back in 1990, we actually experienced one of the highest interest rates for this period at 17.5%. So to put in perspective, now at a 4% cash rate, it is quite significantly lower than what they experienced about 30 years ago. The all-time low being 0.1 in 2021-2022. Now, Billy, you might be one of the only ones here that would have experienced a 17% interest rate back in 1990, but for a lot of us who are a little bit younger, hearing the 4% cash rate going up to about 7% in our realized rates is quite high compared to what we've experienced in the last 5 to 10 years. In saying that, the lowest that we've received, as I mentioned, was back in 2021, so at 0.1%. But if we take a step back, we're actually looking at more of a historic average of prices and essentially our new normal of interest rates. So if we look at the last 30 years of interest rates, what we're currently experiencing could actually go into our new normal and be sort of what we're looking forward and expecting in the next years to come for our interest rates. Going back as well further, one of the main industry sources for mortgage rates, Freddie Mac, they actually have records going back to 1969, which I don't have the graph here, but just a little bit of insight. The fixed rate average for 1969 to 2023 was actually 7.7%. So if we go back even further in time, the average rate has actually increased more substantially than what it is currently for the 30-year period that we're looking at on the table above, or the graph above. Going into that, I will pass it over to you, Billy, and give you a bit of a deeper dive and discuss, I guess, more about future expectations of interest rates and the impact that interest rates will have on the economy, individuals and businesses. So over to you, Billy.
Thanks for that, Steph. And look, really good graph and really good insight into where we are, because what I wanted to talk about is where we're at from a market rate cycle in relation to the rates, and really what we can expect as consumers, as mortgage holders, as participants in the economy around where interest rates are going to go. And it's interesting, that slide that we've got on the screen now, looking at that, what we've had, I guess, since, the GFC 2010 moving forward, we've been in a reducing interest rate environment, and we've had, a really strong decade there where interest rates and the cost of borrowing has really been favourable for mortgage holders. In saying that, we're at the end of that cycle now, and I'll just pivot into the next graph, but where we can expect interest rates to get to. What we're looking at here is basically economists looking at the expectation around where interest rates, or what the next decision is going to be in terms of interest rates. So this is probably no different to what we've seen of late, where the Reserve Bank have been keeping rates on hold, which is a positive sign when we look at it, because it means that the Reserve Bank in a couple of things, but they're looking at the data and then making a decision what to do with interest rates with the data that's coming through. And the data is telling them that we've done enough so far to combat inflation, and they're just taking a position of waiting and seeing. And what we're looking at with this graph here is the economists that have been surveyed for this, essentially 9 out of 10 of them believe that there's going to be no change in the next interest rate decision that we see in October. Whereas 1 out of 10, 9%, 10% believe that we are going to see a decrease. So that's quite interesting within itself, that we're starting to hear in a little bit more from economists and also in the media that people are starting to think about increases, about decreases rather than increases. So it's a sign that we're heading in the right direction with interest rates, and the fact that we're starting to get on top of inflation and it's moving in the right direction is a positive sign. Now, with the notes that came out from the RBA's board meeting in September, the RBA have commented that Australia has passed its peak in terms of our inflation. So we're starting to come down. The RBA are confirming it, the data's confirming it. But what they are saying is that it is still too high, and they'll still do whatever's necessary in order to get it into the target range of 2 and 3%. So the good news is it's coming down with the interest rate at the position that they are now. So the decision to just sit tight I think will continue until that data continues to either keep doing what it's doing and heading downwards from an inflation perspective, and they won't seem to change their stance on that until we see something that's unexpected from the data that comes out in relation to interest rates. Now, in relation to inflation, sorry. Now, interestingly enough, 3 out of the 4 big banks are of the opinion that we have hit peak inflation. So I think 75% of the big 4, getting consensus across the board with those is probably a really good number, because every time you hear them talk, everybody seems to have a different opinion. But in terms of what we can expect moving forward with interest rates, and while we're on the topic of the big 4, just to give everybody an indication of how different this can look depending on which economist that you're listening to, CBA are expecting that as early as March of 2024, we're going to start to see interest rates start to come down, and they're anticipating that by the end of 2024, the official cash rate will be 3.1%. So essentially what they're suggesting is if the RBA moves down in the 25 basis point movements over 2024, starting from March, we're going to see 4 decreases, and it's going to settle at 3.1% at the end of next year. Westpac, on the other hand, have got a different take on this. They're looking at the decreases starting in September 2024, and they're of the opinion that it's going to go down to 2.6% by 2025. So that's a substantial change from where we are at the moment. If that plays out, then obviously that's going to be a welcome reprieve for mortgage holders. I don't necessarily know if that's going to be the case, because then when we look at the data from NAB, they're saying that we're going to see a series of cuts in 2024 and 2025. They're not as specific around a particular month or a particular time of the year, which is interesting because their language around it is a little bit softer, but they think by 2025, we're going to settle on 3.1%. So they think that we're going to end up in the same position as what CBA had suggested. And ANZ really didn't want to commit in terms of their contribution to this, but they basically said that we're going to see a 25 basis point cut by late 2024. So to give you an idea across the board, everybody seems to have a bit of a different opinion on it. And I guess there's so much to play out between now and when we start see that happening. And the call out that I think I wanted to make is that we saw interest rates increase quite dramatically over, we're talking 400 basis points over 11 months. When the economy or when the Reserve Bank are comfortable with where the economy is at, and if they need to do anything else to tweak the interest rate lever to stabilise inflation, I don't think that we're going to see rates come down anywhere near the speed of the way that they went up. So I think that's a really big call out, because what we had seen previously, and that was that slide Steph was describing before, but that was just a different time frame. And if we keep rates at a more normalized level, which is where we are now, at least it gives our Reserve Bank and central banks across the world, it gives them ammunition to be able to move rates particularly down if they need to. Whereas if you're at a 0.1 cash rate, you can't really do anything in order to stimulate your economy. You can't go further unless you go negative interest rates, which is something that Japan did, and it didn't seem to work. But yeah, I think that's a really interesting call out, that we shouldn't expect that interest rates are going to go down at the same speed or to the same level as the way that interest rates went up. So one of the things that I wanted to just call out as well too is in terms of the impact of interest rates on the economy and how it affects, I guess, people's behaviour around what it looks like and why the government uses interest rates in order to a certain extent, manipulate everybody's behaviour. And that's the mechanism to be able to either stimulate the economy or slow it down. So in this instance, the Reserve Bank are trying to slow the economy down because inflation is too high. So what they're hoping to achieve, and what is playing out, is that by increasing the interest rates, we're going to achieve slower economic growth. And the way that happens is it's more expensive with interest rates increasing, it's more expensive for businesses and for individuals to borrow money to be able to invest and grow. So this naturally leads to people spending less money. Now, from a business's perspective, if your cost of borrowing has increased, you may want to invest less. You may want to buy less plant and equipment. It could also mean that unemployment rises as well too. We're quite fortunate at the moment that unemployment is at record lows in Australia. The expectation is that we will see unemployment tick up. I've got some data around that as well too, but where the Reserve Bank are anticipating that needs to go up in order to support the economy at an optimal level. So not only do they talk about the target range of inflation being 2 to 3%, there's also a particular sweet spot where unemployment sits as well too. In terms of what happens from a household perspective, the biggest impact that we see with higher interest rates, no big surprise here, is that mortgage repayments increase. So to give us an idea of what this looks like, if we're talking April of 22 versus where we are today, if you've got a mortgage of about $500,000, the difference between your repayments, the increase from April to today, is about $1,100 odd, an $1,100 increase per month. So if you consider, not that long ago, April of 2022, you're paying whatever it is that you were paying. Fast forward to today, that household needs to find $1,100 more per month in order to service their loan. What that's also led to as well too, and we're seeing it across our lending business as well, is that, and you might have heard it in the media about people being in mortgage prison. So what this means is that as interest rates have gone up, it's impacted people's serviceability and they're unable to refinance from one lender to another, which means that if they're on an interest rate that's not competitive, that essentially the term is that they're in mortgage prison because they can't afford to refinance with another lender, because in the eyes of the lender, on the new increased rate, that individual or that household can't service that level of debt. So as a consequence, what happens with that is that they're stuck with their existing lender that may have a rate that's unfavourable. Some of the other things that we're seeing with increasing interest rates is it's not just home loans, but all types of loans. So things like consumer debt, car loans, credit cards, that increases. And ultimately what it leads to, and this is what the Reserve Bank are banking on and we're starting to see, but it's softening consumer spending. So what it means is because people have got less money in their pockets because they are spending more money servicing their mortgages, it means that they've got less discretionary income to be able to spend on other things. And in turn, businesses are receiving less income because people aren't spending as much and the economy starts to slow. And what that does is it just creates cash flow challenges for people as they're contending with higher mortgage repayments and just trying to make their budget meet their expenses and making sure that they can continue to operate in a higher interest rate environment. But the interesting call out is that this is here to stay. I think we may see a little bit of a reprieve. I think it's probably closer to where the CBA are pitching it. So we'd be expecting that we're going to start seeing some interest rate decreases maybe the end of Q1 next year. And yeah, I think it'll be a little bit of tweaking here and there throughout 2024, but we shouldn't be expecting too many huge differences. So I don't think it's going to be material enough. If households are experiencing cash flow pressure, I don't think any interest rate decrease is going to be material enough that it's actually going to unwind them out of that position. So yeah, just an interesting call out. But look, enough from my end. Andrew, I might hand it over to you. You're going to be talking about the employment market, migration, and the outlook for investment markets. So Andrew, over to you. Oh, you're on mute, Andrew.
Someone had to do that eventually, right?
There's always one.
Thanks for that, Billy, and obviously Pat and Steph giving some insights into the interest rate market as well as the inflation market. It's the two really hot topics, and that's what really everyone is talking about and everyone is concerned about, because those are the two big things that really are impacting investment markets. And so a really good segue into that is unemployment. So currently, as Billy sort of alluded to, we're touching 3.7% in terms of the current unemployment rate in Australia. Now, for a lot of people, you naturally think, great, unemployment is low. That's exactly what we want in an economy. We want people to be employed. We want people to have jobs, and the lower that it can be, the better that it is. We have seen markets perform contrary to what they have done in the past, whereby unemployment has actually gone down, and we've seen investment markets go down as a result of that. Now, the main driver and reason behind that is really that when people are employed and when the unemployment rate is incredibly low, people are more likely to spend money. The more likely they are to spend money, the higher the inflation within the economy. So inflation ticks higher, RBA then has to increase interest rates even further in order to slow down the economy. And so ultimately what the RBA would like is for unemployment really to hit a normalized number of close to 5%. They expect this to trend towards 4.5% in late next year. And the 3.7% has been, I mean, if you look at it in 1 month in isolation, we have seen the unemployment rate increase, which is the direction that the RBA wants to take this. However, we've already touched 3.7%, and I'm not sure whether you can see my cursor, but we've already touched that a couple of times, and all that we've done is unemployment's tick down and bounce back up and tick down and bounce back up. So really what they'd like to see is that unemployment rate start to rise a little bit in order to be able to bring the inflationary pressure in the economy, really start to ease some of that through some of the measures that they're doing, primarily with interest rates. Now, the other thing that is also having or going to have a very large impact on inflation is migration. So may have heard about it or may have heard in the news recently, but we had a record net migration. Now, net migration is not just the number of people that have come into Australia, but rather the number of people that have come into Australia less the number of people that have exited the country. So in 2022, we saw 386,000 people into Australia in net migration. That was a record. So that was the largest net migration that Australia had ever seen. We saw that increase even further. So we hit another record in March of 2023, whereby the 12 months previous to March was 454,000 people in net migration in Australia. The likely outlook for the next 12 months is another 450,000 people. Now, I've done some basic numbers, and if we add all of those numbers up and look at a 3-year time frame, we're talking about approximately a 5% increase in population in Australia purely through migration. So we're not talking about people having children or anything like that, but a substantial increase in population. This is way above trend. And so some of the policies, and this happens in any economy, so it's not just Australia, but the left hand doesn't talk to the right hand. The left hand is really trying to keep inflation under wraps, is really trying to slow down the economy. And the right hand is bringing people into the country, which fuels inflation. The more people that there are that are entering into an economy, the greater the demand for goods and services and the higher the price needs to be as a result of it, unless supply increases dramatically, which we're not likely to see. So there's really an inflationary impact when you're seeing such large migration numbers, which may sort of impact what further decisions the RBA makes on inflation or on interest rates. Now, one of the really big things that this has had an impact on and will continue to have an impact on is rental properties. So what we've been experiencing in the rapid rise of the cost of being in a rental property is likely to continue, and there's likely to be even further pressure. A lot of migrants that enter the country are either students or even skilled migrants that may or may not have the ability to purchase property just purely with their visa requirements. And so this has a dramatic impact on the rental property market because these people do need to live somewhere. So we are really seeing some inflationary pressure that the government is putting on, purely just in the form of migration and people coming into the country as well. So putting all of this information together and really looking at an outlook of what investment markets look like over the course of the next 12 months, 18 months, 24 months, pick your time frame, but short time period is what we're talking about here. A key element of all of this is there's debates, and if you read my first dot point there's some debate around whether excess saving has been fully expunged. So some economists are saying that, okay, through COVID, people had excess savings, people built up savings, they weren't going out, they weren't spending money as much as what they have been, and so there was an excess savings buffer. Economists are debating whether that's fully expunged or whether that's just almost fully expunged, but nonetheless, the consensus is very much that those excess savings have at least almost been expunged. Now, that is essentially what the RBA has been wanting to do. Excess savings does fuel inflation, and so as a result, they've really wanted to drop that down. The concern, however, is if people's excess savings have been expunged, that really means that household budgets have been spending more than they've been earning. Now, if that's expenditure has been discretionary expenditure in going out, going on those holidays that you missed out on as a result of COVID, that's okay because people can put a stop to that. If that excess spending has been as a result of the RBA pushing too hard on the interest rate lever, that's when there is some concern around, is the economy really going to take a tumble if people are going to need to start offloading properties or really start taking dramatic measures because of their savings rate declining? To maybe put people's mind at ease, the concept of a soft landing is essentially exactly what it sounds like. The economy has, or the RBA has managed to slow down the economy, but not too much. And so we haven't gone through a recession in order to be able to combat inflation. Now, me or probably any economist doesn't have the guts to say that we are going to experience a soft landing. However, more economists are now starting to swing on the side of we may actually get a soft landing. So everyone was talking about a very narrow path, and it looks like we are navigating through that. And it looks like there is more people and more economists starting to err on the side of we might actually, in fact, experience a soft landing, which was an unheard of thought if you were talking to most people 12 months ago. So there is some positivity from an investment market outlook. The property side of the economy is a really interesting one. There's way too moving parts for anyone to make a definitive call. There's a limited supply of property already, which is why you are to some degree seeing the rental market really heating up and has heated up and will continue to do so. But we've also seen some builder defaults as a result of the higher cost or higher materials cost. That's also going to have both a short and long-term impact on the supply of properties. If builders not producing properties at the level of what we've experienced in the past as a result of the amount of defaults, then we're also going to see a limited supply there. The impact of interest rates, what everyone has been very surprised about is the resilience of mortgage holders. Mortgage holders have really held on to properties. The expectation was that there would be more properties on the market as a result of people feeling cash flow pressure. That hasn't really happened. So we haven't really seen too much of that come into the market. The effect of that is yet to be known. And that is ultimately what RBA is concerned with, and why we are to some degree seeing a pause in terms of the interest rate rises is the impact of one interest rate decision is not going to impact a decision that a individual consumer makes for probably 12 to 18 months. It takes time for that to flow through the economy. And so the RBA has been trying to make decisions based off data today and a decision that will impact in probably 12 months' time. You couple that all up with more people coming into the economy as well, and the net migration problem, or whether you see it as a problem or a benefit, but the net migration that's coming into Australia. And essentially, property is this one thing that I don't think that there's any consensus from an economist perspective as to what is likely to happen over the next 12 months, because there are so many moving parts in that sector. What we are very likely to see, at least over the next 12 months, is a slowing economy. That is the intention of what the RBA is trying to do. And hence we are likely to see GDP growth slow and the economy start to slow down as a result of that. So the $1 million question therein is, what do you do? Got all this information, how do you best position yourself? How do you actually position your own investment decisions and what you do on a day-to-day basis as a result of all of this information? Now, everyone wants to jump to what investment decisions do I make in order to make a solid profit and make the most of this. And yes, absolutely, that's something that's going to be valuable. But budgeting and cash flow and your own budgets and cash flow is going to be the absolute key. I think from what Pat, Steph, Billy, everyone has discussed over the course of this webinar is we're not likely to see any reprieve in the short term from a cash flow perspective. Inflation is high, and even if the inflation rate comes down, that does not mean that prices come down. That means the prices are not increasing as rapidly as what they have been. So you're likely to see prices, at least from an inflation perspective, stay where they are unless inflation moves negatively. Interest rates. Yes, we might see some reprieve from an interest rate perspective over the course of the next 12 months, maybe 24 months, but it's not likely to be incredibly significant. And so if you're not addressing your cash flow problems now, and if you're not addressing any budgeting problems that you might be experiencing now, waiting for the economy to do that naturally is, I don't want to say suicide, but it's definitely not what you want to be doing. From an investment perspective, stick to your long-term strategy. Make sure that you're investing long-term. You're not looking short-sighted. You're not looking at what's happening today or tomorrow. What you're looking at is what's going to likely happen over the course of the next 10 years. So invest over the long term, invest in good quality assets, diversify, so don't have all of your eggs in one basket. As Pat mentioned, put some of your money in property, some of your money in international shares, in Australian shares, in bonds, in assets that will also mitigate risk, because that's what's ultimately going to give you the best chance of long-term success. The one aspect of that most economists will talk about is that there's some resurgence in the bond market. It's never been an exciting market. I've never heard more people talk about bonds than in the last couple of months. But if we are talking about peak interest rates, the value of bonds or government bonds will generally work inversely with interest rates. So in a market where interest rates are declining, what you're likely to see is the valuation of government bonds increase. And so we are likely to see the bond market, at least over the medium term, do well in this period. And it will also act as a risk mitigation measure. If the RBA is not able to ultimately reach a soft landing, and we are likely, and if we do see the economy go into some form of recession, the bond market is going to provide, or what they're likely to do is cut interest rates to spur on that economy. And so the bond market is likely to do well as a risk mitigation measure. The next chart, just to kind of put all of this together and really hone in on the fact that making decisions long term rather than spur of the moment are what's going to be your ultimate key to success. Is if you look at what Vanguard does is ultimately look at how a $10,000 investment would have performed in a given market over the course of, and what they've done is they've actually modeled this from 1993 to 2023. So we're talking about a perfect 30-year time horizon here. Inflation, if you invested $10,000 over the course of this 30-year time period, that $10,000 just purely by rate of inflation would be at $21,979. By putting that in cash, which is ultimately a term deposit, cash would have returned you, or that $10,000 investment would be worth $34,737. Now, this is slightly above just pure inflation. And so what we have seen, or some of the discussions that we've seen as advisors is, okay, great. Interest rates have gotten to what feels like a high level because we haven't seen interest rates at this level for a fairly long period of time. Do we just sell our investments, don't take any risk, put it into cash, and that's it? Everything's all good and well. Sounds like an attractive proposition, 4.5-5% rate of return 12 months ago or 6 months ago felt like a good rate of return for not taking on any risk. However, if we then take a step back and say, we can't time the market, no one can. No one knows when the market's going to boom, when the market's going to bust, and is going to be able to time that perfectly. If we leave money in cash, we're ultimately not going to be able to do much other than, slightly beat CPI, versus having put that $10,000 in international shares that would have returned 176,000 or would be worth 176,000. Or Australian shares that would be worth 138,000 over that time period. Take a step back, invest in good quality assets, dollar cost average, so invest regularly over a period of time so that you smooth out those fluctuations. Don't invest beyond your means. So that is also another key and important takeaway over this. And to some degree, tune out the noise and recognize that this is either a spike or a decline. And once you zoom out and take a step back, it's going to be fine as long as you're making good quality and rational decision making. And I believe that I'll pass it over back to Billy just to round us all out and close out all of this. But also want to take the time while I'm on the mic to thank everyone for tuning into the webinar as well. We really do appreciate it.
Thanks, Andrew and Pat. Andrew and Steph, thanks for sharing your insights into the state of the economy and the outlook moving forward. We've had some questions. We've actually had 4 questions, so we'll take one each. Pat, we might throw it over to you first. This question is from Diane. It was when you were talking about how much cash you should have, because one of the ways or one of the things to think about during an inflationary environment is not keeping too much in cash. But I think where this question was going is, you spoke about having 3 months of living expenses in cash. Do you just want to talk through that a little bit? Because Diane's question specifically was how much cash is too much?
Yeah, absolutely. And thanks for the question, Diane. There's no real right answer to this. And the reason why I've kind of said 3 months worth of living expenses is because every family household is going to be different to another's. 3 months really represents a good buffer to be able to reasonably save and have a bit of a buffer to be able to rely upon if, the proverbial hits the fan. The main thing around having that buffer and whether that's, let's say your family household is spending $10,000 per month. Obviously, you want to average out to about $30,000 in terms of just savings there. Any more than that, and I'll caveat this to say that any more than this with the expectation that you're not purchasing something major like a new car, you're buying an investment property, you're putting you're saving up for a deposit for an upgrade of the home or whatever it may be as well. That's the exception to the rule, because obviously you need to have cash on hand to be able to put down your 10% or put down your 20%, whatever it may be. But the idea is that you've got your 3 months worth of living costs and then any other planned expenditure over the next 12 months. What you don't want to do is invest money away within that 12 months with the expectation that you need to then sell to then buy something else thereafter. So that's what I was alluding to.
Okay, thanks, Pat. Steph, I might chuck this one over to you. This is from Michelle. So she asked, looking ahead at the economy, what are the things that we should keep an eye on?
Yeah, really good question, Michelle. That's fantastic. Thank you for asking. I guess it's different things we touched on during this presentation. So as Pat mentioned, making sure you have a bit of a buffer as an emergency fund, and I guess really basic principles in finance and budgeting tips and saving essentially. So especially if you're coming off a fixed rate mortgage, there's still a lot of clients that we face today that have fixed rate mortgages, just ensuring that you are preparing yourself for that rate jump when that does come. If you are lucky enough to be on a low rate currently, just anticipate what a 5.5%, 6% rate would be. Have that money put aside each month as if the rate was currently that for yourself. Probably one of the most handy tips that we're giving clients at the moment that have mortgages. When it comes from other examples or economic factors that you want to look ahead at the economy, keep an eye on what the inflation rates are doing each month to month, what the interest rates are doing month to month when those announcements do come out. Dive in, understand, I guess, what drives those factors and where you're positioned in that market as well. A lot of people are quite fortunate at the moment they are employed. Keeping an eye on what business or what industry you're employed in can make a difference as well. Self-employment, ensuring that you are looking at all the options and the economy as a whole and what your business entails, and whether there are things that you can be doing to future-proofing your business for that purpose as well. From a generalized perspective, that's pretty much everything. That we can go into a lot more, and I guess it does cover everything that we do day to day, but yeah.
No, lovely. Thank you, Steph. And Andrew, one over to you. This is from Nicole, just about the bond market. So is it still looking like a good time to enter the bond market?
Yeah, I mean, look, the general answer to that is yes. I think there's a lot more nuance when you go into that as to, is now the most optimal time to be entering the bond market? Is it in 3 months' time? Is it in 6 months' time? Is ultimately yet to be known. But if we do look at, over the long term, entering the bond market now can be quite a positive move. The caveat that I will sort of put on that, though, is bonds should always represent a portion of your holdings and not all of your holdings. If I jump back to that Vanguard index chart, that we look at a $10,000 investment that is invested in Australian bonds, for instance, that would have gotten you, or that would currently be worth $49,000 as at today. And so ultimately, over the long term, is bonds your best investment when we look at things long term? Probably not. A property investment or an international or Australian share investment would have performed better than a bond investment over the long term. However, where we do see ourselves from an interest rate cycle does mean that there's some opportunity to get an upside on an asset that's historically just very defensive and forms part of your portfolio really as a risk mitigation measure. So that's the long-winded answer to my short answer there, but thanks for your question, Nicole.
All good. And there's one question left from Diane again, so thank you for keeping those questions coming through. This was around CPI and the measure of inflation. And your question was, is it different per state? So each individual state and territory in Australia does collect CPI data. What we were talking about with the numbers before is when they're aggregated across the country. So when you hear the stuff in the media, talk about the inflation rate across Australia, it's everything that's added from all of the states. But yes, it is measured per state and per territory. So if anybody was interested in that, we can get that information out as well too. Just keeping in mind that inflation is measured on a basket of standardized goods and services. So that measure is the same across each state and territory, and it's the price movement of those from one recording period to the next. So as an example, if there's been a spike in, let's say, groceries from an example, but if there's been a spike in groceries, that represents a certain weighting in that basket of goods and services that measures inflation. So you hear economists talk all weird and wonderful things about things like headline inflation numbers and seasonally adjusted and things like that. That's just the technical term for them just adjusting or excluding out things that can vary quite a lot in terms of price movement. So they try and normalize it. But yeah, there is a measure across each particular state and territory. So if anybody was interested, like I said, we can get that data out there. But look, just finally wanted to thank everybody for joining us today on our economic update. We hope you found the presentation insightful and valuable. And if anybody's got any questions, as always, feel free to reach out to any of the 360 team members, and we'd be more than happy to help answer those. It's been a pleasure having everybody here today. Thank you once again to our speakers. Take care, everybody, and enjoy the evening. Good night.
Thanks very much, everyone.